the architecture of wealth, a manifesto for survival and prosperity. 2026. If fate played a strange joke on me, and I found myself once again, a 25-year-old young man standing on the threshold of adulthood in 2026, my action plan would be ridiculously simple, and at the same time, infinitely complex for most people. The world around me would undoubtedly have changed beyond recognition. Artificial intelligence composing symphonies, quantum computing, colonization of digital universes. But if I woke up in this new world with the experience I have accumulated over a century, I wouldn't do anything exotic. Absolutely nothing. The world adores the illusion of novelty. People, especially the young and hot-headed, love to imagine that investing is some kind of living entity that constantly reincarnates, shedding its old skin. They look at cryptocurrency charts, at the volatility of Bitcoin today, and say, "This is a new era." But I've seen this play too many times. The sets change, the actors' costumes change, the slang they speak changes, but the play itself remains the same. In 1999, it was the stocks of tech companies that didn't have a cent of profit, but promised to change the world. In 1972, it was the Nifty 50, a group of stocks that seemed like they would never fall. In 1637, in Holland, people mortgaged their homes for tulip bulbs. Do you think that Bitcoin or neural networks in 2026 are something unique? It's the exact same tulip mania, just in a digital suit. The fundamental truth that the majority refuses to understand is that markets don't actually change. Why? Because markets consist not of numbers and algorithms, but of people, and human nature hasn't changed in millennia. The exact same cocktail of greed, fear, envy, and impenetrable stupidity keeps playing on an endless loop. If you realize this simple fact, that at the core of any market movement lies primate psychology, as old as the world itself, you already have an advantage over 90% of investors. Most people look for a mathematical formula for success, while what they should be looking for is psychological resilience. When I was young, I, like many others, fell into this trap. People around me considered the stock market a sacred temple where geniuses gather to decide the fate of the economy. I believed that for about 5 minutes. Then, looking closer, I realized that this place is much more like a casino. A huge, sparkling casino where crowds of people enter with the firm belief that they are smarter than the dealer. Spoiler alert. They aren't smarter. And unlike a casino, where the odds are at least fixed by mathematics, in the market, people play against their own psychology, and the dealer is their own emotions. So, if I were starting out in 2026, I would begin with the exact same boring, tedious principle that worked in 1946, when the world was recovering from the war. In 1976, when inflation was devouring savings, and in 2006, right before the crash. This principle sounds almost insultingly simple. Spend less than you earn. I can see you rolling your eyes. That's cliché, Charlie, you'll say. But listen to an old man. Save aggressively. Set aside every cent that doesn't go toward maintaining basic sustenance, and channel that money into productive assets. Do you understand the meaning of the word productive? It's something that creates value while you sleep. That's it. No magic, no gurus in expensive suits. Just arithmetic. The problem of the modern world, and the past world too, lies in the obsession with shortcuts. In 2026, it will be crypto bros, cowboys of SPAC deals, prophets of new technologies, assuring you to buy companies that have no profit but have potential. They are all selling the exact same thing, a miracle. A miracle that will allow you to skip the most unpleasant part of wealth, discipline. Everyone is looking for a secret passage, a cheat code to life. It never ends well. Let me hit you with a cold shower of reality. If you aren't ready to set money aside and not touch it for a decade, you are not an investor. You are just a gambler with a brokerage account. You are no different from a person betting on red. Only your roulette table is called NASDAQ or S&P 500, and Wall Street adores such gamblers. They are built to sell you dreams at retail prices, at the peak of the hype when everything is expensive, and buy up your panic at wholesale prices when everything collapses. That is their business model, siphoning money from the impatient to the patient. If I were starting now, my first step would be total informational isolation. I would start by ignoring 99% of financial media. All these TV channels, blogs, tweets, endless streams of analytics. It's just noise. White noise, designed to confuse you and force you into making unnecessary moves. Analysts, strategists, talking heads on TV. Most of them don't even invest their own money the way they advise you to invest yours. They sell content, not wisdom. Their job is to hold your attention between commercials, not to make you rich. Why should you listen to them? Instead of trying to find the needle in the haystack, I would just buy the whole haystack. I would build a foundation out of broad, low-cost index funds. Why? Because the statistics are relentless. These boring funds quietly but confidently outperform the majority of star fund managers over the long distance. This was true when Jack Bogle, that saint of the financial world, launched the first index fund in 1976. And today, in the era of algorithms, it is even more true. Sounds boring? Excellent. Boredom is your best friend. Boredom is safe. Exciting investing is expensive investing. Emotions in the market cost money, and usually, you are the one paying it. But I wouldn't stop at just the index. I would train my brain. I would tune it like a hunting dog to sniff out rare, obvious opportunities. Notice I said rare. Maybe once or twice a year. Not every day, not every week. Real opportunities don't arrive on a schedule like trains. They happen when the market goes crazy with fear or greed. Most people confuse activity with progress. They think that if they trade every week, shuffle their portfolio, and read the news, they are in the game. In reality, they are just feeding the broker with commissions and slowly bleeding themselves dry. If I were you, I would spend less time trading and more time reading. You cannot outsmart the crowd if you understand what is happening worse than they do. And the crowd, as a rule, understands nothing. If you don't read history, you are doomed to think that every bubble is a new invention, a path to a brighter future. In 1929, shoe shiners were giving stock tips to bankers. That was a signal. In 2007, taxi drivers in Miami were flipping condominiums without a penny to their name. That was a signal. In 2021, teenagers on Reddit fancied themselves the wolves of Wall Street because they managed to pump the stock of a dying video game store, GameStop. If you don't see this pattern, if you don't recognize this melody, It means you are the mark at the poker table. There is another thing, perhaps the most important one. If I were starting today, I would tattoo this onto my subconscious. Envy is poison. Not just a flaw, but a deadly toxin. Envy makes you desire what others have, and usually at the worst possible time. Your neighbor brags that he doubled his money on some startup or new coin. Good for him. Clap politely, smile, and stay far away from it. I have lived long enough and seen enough bubbles to know the punchline to this joke. Those who arrive at the party last, when the champagne is already warm and the music is too loud, they are the ones who leave without their pants. Don't be late to stupid parties, and better yet, don't go to them at all. So, how would I invest if I were starting in 2026? Let's structure this. First, live below your means. It sounds dreary, I know. You want to spend, consume, show off your success. But it is precisely this boring habit that makes you bulletproof. When you don't need much, you cannot be frightened by poverty. Second, stick to what you understand. You don't need to be smart at everything. You don't need to be an expert in biotechnology, cryptocurrencies, and the colonization of Mars all at once. You just need to not be a fool within the narrow circle where you put your money. Third, let compound interest do its job. It is slow, it is agonizingly slow at the beginning, but it is an invincible force. It is the eighth wonder of the world. Fourth, avoid envy, debt, and drama. These three horsemen of the apocalypse have destroyed more lives than all bear markets combined. And finally, embrace boredom. Wealth is not built chasing thrills. It is built by patience, letting time and discipline do what others are too impatient to wait for. If this advice disappoints you with its simplicity, I will tell you what I once told a group of ambitious students. It isn't supposed to be easy. Anyone who thinks getting rich is easy is a fool. If I were starting over in 2026, the very first lesson I would burn into my brain would be this. Envy will bankrupt you faster than any crisis. Not fear, not greed, but envy. People catastrophically underestimate how destructive it is. Greed wants more. That's understandable. It's an engine. Fear runs away. That's the instinct of self-preservation. Both can be managed. But envy forces you to chase someone else's stupidity and call it a strategy. I saw this when I was young, in the 1930s, after the Great Depression had chewed up and spit out an entire generation. Families were still trying to keep up with the Joneses. They lost their homes, their businesses turned to dust, but they retained their pride. Damned pride. Pride doesn't buy groceries. Pride makes you borrow money. You don't have to show a face you don't deserve. This disease hasn't gone anywhere. In 2026, it simply wears shinier clothes. People see their neighbors driving new Teslas or their equivalents, buying NFTs, pictures of monkeys for millions, trading on apps like Robinhood from their phones during lunch. Instead of thinking clearly, one question rings in their heads. Why not me? And at that moment, the avalanche begins. The funniest, or rather the most tragic part here, is that envy harms not only the fool who feels it, it poisons entire markets. Remember 1999. Everyone envied the dot-com millionaires. There were kids who barely knew how to write HTML code, but suddenly were worth $10 million on paper. The envy was so strong, so tangible, so thick that professionals, people with experience who should have known better, also jumped into this cauldron. Doctors, lawyers, engineers, the intellectual elite of society. They all thought they were missing out on the chance of a lifetime. By 2002, most of them had only missed out on one thing: their money. Envy turns markets into a herd of buffalo running in panic. And when that herd is running towards a cliff, you don't want to be in the middle of it. If I were investing today, I would treat envy like rat poison. Don't touch it. Don't taste it. Don't even sniff it. People often ask me, "Charlie, what about ambition? Isn't ambition a good thing?" Of course, it's good. But ambition and envy are two very different beasts. Ambition says, "I want to become better. I want to improve myself." Envy whispers, "I want what he has, even if it destroys me." Guess which feeling dominates financial markets? The problem is that envy masquerades as logic. A guy sees his colleague triple his money on penny stocks. Suddenly he tells himself, "If I don't invest in this, I'll fall behind." It's risk management. No, it's not logic. It's jealousy pretending to be math. You don't need to beat everyone. You just need to avoid the fate of being a sucker. Warren Buffett and I never tried to be the richest. We just tried to be consistently not stupid. And that turned out to be enough. Let me tell you, avoiding stupidity is much easier than chasing genius. I'll give you an example. During the real estate mania in 2006, people physically couldn't stand the sight of their neighbors buying houses and flipping them for $50,000 more half a year later. It drove them crazy. So they jumped on this train and borrowed money to do the same. Some had 5 mortgages on 5 properties they couldn't afford to service, all because they couldn't bear the sight of the other guy getting ahead. By 2008, they were no longer ahead. They weren't even on their feet. Do you think envy is harmless? It is deadly, and it always ends the same way. The envious person is left bankrupt, bitter, and blaming the universe for his troubles. Here is what rationality is. Be happy when others succeed. If your friend made $1 million in crypto, great. Be happy for him. It's not your million. If your neighbor retired early because she bought Apple stock in 1980, applaud her and move on to mind your own business. You cannot live life by someone else's scoreboard. It's a race you will never win. If I were starting in 2026, I would carve this with a knife into my desk, ignoring envy, focusing on endurance. Because here is the secret. Compound interest rewards only those who survive. If you blow up your account chasing someone else's returns, you won't even get the chance to let the magic of time work for you. When Warren was once asked why we don't envy hedge fund managers making billions on risky bets, he said something like, "What's the point? We already have everything we need." That is the attitude you want to cultivate. Enough means enough. Envy is infinite, and infinite hunger is just another word for suffering. So if you need a rule for 2026, here it is. Stop looking at your neighbor's lawn. Your own will grow just fine if you water it with patience and discipline. The dumbest sin doesn't even bring pleasure. That's why envy is the worst of all. Lust at least has its moments. People love to imagine that Warren and I never made mistakes. That's nonsense. We made plenty of them. The difference is that we tried not to repeat them. If I were starting in 2026, I would remind myself of a simple fact. One big mistake can erase 10 smart decisions. I know this firsthand. Back in the 1960s, I was seduced by what I call cigar butt investing. The essence is simple. You find a company that looks terrible. It's almost dead. But there's one last puff left in it. You think it's cheap. You think, I'll squeeze that puff out, make a little easy money, and move on. The problem is that cheap garbage usually remains garbage. You are not just buying the last puff. You are buying all the headaches that come with it. Once, I bought a stake in a company called Hochschild, Cohn & Company. It was a department store in Baltimore. The numbers looked temptingly cheap. The assets seemed to be worth more than the stock price. I thought it was the deal of the century. It wasn't a deal. Retail is a brutal business. Endless competition, paper-thin margins, changing consumer tastes. You are fighting giants with deeper pockets and better locations. I learned this lesson the hard way. I lost millions. Money that could have turned into tens or even hundreds of millions if I had simply invested it in businesses I truly understood and admired. This lesson stayed with me forever. Don't reach for cigar butts. They look cheap. They are cheap. And they are cheap for a good reason. Looking back, I think this mistake probably cost me half the fortune I could have made in my lifetime. Half. Think about that. The opportunity costs are staggering. If I were starting over in 2026, I would make this a rule. Only buy a business if you would be perfectly happy holding it for 10 years, even if the stock market shut down and you couldn't see the quotes. If the only reason you own an asset is because it's cheap, you are already on the wrong path. Warren and I ended up completely changing our approach because of this. Instead of buying fair, mediocre companies at wonderful prices, we decided to buy wonderful companies at fair prices. That was a great turning point. It sounds obvious now, but it took years of scars and losses for it to sink in. The irony is that cigar butt investing still tempts beginners. In every decade, they think they are smarter than the last. They think this garbage stock is simply undervalued by the market. I'll be the genius who turns trash into gold, they say. In most cases, the trash just rots. Here's the real math. If you buy a lousy business cheaply and it stays lousy, you tie up capital that could have been working in a wealth creation machine. It's not just a small loss. It's a massive, invisible loss of missed opportunities. In 1993, we bought Coca-Cola. It wasn't cheap, not a cigar butt, but it was a great brand with pricing power and global dominance. That investment multiplied many times over. Compare that to Hochschild Cohn, a total disaster. So if you ask me what to do in 2026, the answer is simple. Skip the garbage. Don't fall for cheapness. Look for solid businesses with economic moats, honest management, and the ability to grow for decades. And if you can't find them, park your money in an index fund until you do. Patience is underrated. Most people think they will get rich by being clever. I got rich by slowly removing stupidity from my arsenal. Don't buy crappy businesses just because the price is low. That's like buying a car without an engine because it's 20% off. A discount that goes nowhere is not a bargain. If I were young today, I would write this rule in bold letters. Avoid cigar butts. They stink. A mistake that cost me millions is not something I would repeat in 2026. And if you are smart, you won't make it either. If I were starting out in 2026, I would keep one ugly truth at the forefront of my mind. Most people are too confident in themselves. The markets brutally punish this kind of arrogance. When I was young, I thought intellect alone was enough to win. If you're smart, you can outthink the crowd. But over time, I noticed something disturbing. The smartest people often made the stupidest mistakes because they couldn't imagine they could be wrong. Confidence without humility is a wrecking ball. Take the stock market of 1929. Everyone knew the prosperity would last forever. Stocks only go up, they said. Even experts repeated it like a mantra. But you know how that ended. Or look at the housing bubble of 2006. Everyone knew that real estate never falls in value. Entire families mortgaged their futures because they couldn't imagine losing money on a house. By 2008, they stopped being homeowners. They became bankrupts and tenants of the bank. The problem is not ignorance. Ignorance is curable. You can fix it with study and patience. The problem is certainty. Certainty makes you deaf. I've seen it in boardrooms. Some manager presents rosy forecasts. Everyone nods because they don't want to look stupid asking questions. And then reality comes and punches them in the face. If I were starting now, I would cultivate what I call inversion thinking. Instead of asking why I am right, I would ask how I could be wrong, where I could screw up. This single mental exercise will save you more money than all the hot Wall Street tips combined. Inversion forces you to confront your blind spots. You stop asking, "How do I win?" and start asking, "How do I avoid losing?" This is a much saner approach to life. People are addicted to their opinions. They nurse them like children. Beautiful, special, above criticism. But most opinions are trash. They are picked up from TV, from neighbors, from a Twitter feed, or from wherever noise is cheapest. Why should you bet your future on something so flimsy? If I were 20 years old today, I would build my worldview slowly, brick by brick, based on primary sources. I would read old annual reports, not headlines. I would study real data, not opinions about data. I would listen to history, not the current hysteria. And here's the kicker. I would still remind myself that I could be wrong. Even after all this work, Warren and I built our partnership on this habit. We argued. We challenged each other. Sometimes we changed our minds, and it saved us from disasters. Two rational minds doubting themselves are better than one genius certain of his brilliance. There is a reason why you rarely see us boasting about predictions. We don't believe in them. The world is too complex, too unpredictable. Instead, we focus on principles that don't change. Live within your means. Buy quality. Be patient. Avoid debt. You don't need to know where the market will be next month. You just need to avoid doing something stupid today. Overconfidence has another unpleasant side effect. It makes people talk more than they listen. In investing, this is fatal. The market doesn't care about your opinion. It doesn't care about your ego. It doesn't care how confident you are. It just does what it does. If you ignore reality because you are in love with your view of things, the market will clean you out. In 2026, the most valuable asset won't be some fancy AI stock-picking algorithm. It will be humility, the ability to say, "I don't know," and truly mean it. Most people can't do that. They would rather sound smart than be smart. And that is exactly why most people stay poor. So, here is the rule. Treat your opinions like milk. They spoil quickly. If you don't check them often, they will stink up the whole fridge. When you are too certain of your opinions, you don't just risk losing money. You risk losing the single thing every investor needs the most: an open mind. If I were starting over in 2026, I would make one thing clear to myself. Don't think like an employee, think like an owner. This distinction is colossal. Most people never cross this line. Careerism is polishing a resume, pleasing the boss, and surviving until the next performance review. Ownership is building something that lasts, taking responsibility for it, and living with the results. The incentives here are diametrically opposed. When I was a young lawyer, I saw plenty of careerists. Bright men, polished, always looking impeccably dressed. They spent their days drafting memos that impressed the senior partners. They made good money, sure, but they were always trapped on a treadmill. Then I noticed the difference between the lawyers who billed by the hour and the people who owned the firm. The owners had leverage. They could stop working and keep earning. The careerists couldn't. This realization hit me like a hammer. If you are only exchanging time for money, you are at a dead end. You need equity in something that grows while you sleep. It doesn't have to be glamorous. A decent piece of real estate, boring utility stocks, a small business with loyal customers, anything that generates income without you typing up another report at midnight. The trouble with careerism is that it encourages short-term thinking. An ambitious manager in a large company doesn't ask what will create long-term value. He asks, what will get me a promotion next year? These are often opposite answers. I've sat on boards of directors where executives proposed stock buybacks, not because it made sense for the shareholders, but because it made the quarterly numbers look good. That's how they got their bonuses. Then they would leave before the long-term damage became apparent. Owners don't play this game. Owners care about longevity, not appearances. If I were starting today, I would focus on finding ways to shift my income from career-based to ownership-based as early as possible. This doesn't mean quitting your job tomorrow. It means directing your savings into assets that give you a claim on productivity. You need a mental shift. I'm not just working for money. I want money to work for me. Warren and I never made our fortunes by being careerists. We didn't climb corporate ladders. We bought the ladders. You might think, Charlie, it's easy for you to say. You had capital. No, I didn't start with much. I lived through the Great Depression. My family lost everything. I built brick by brick, saving, investing, avoiding debt, and thinking long-term. Ownership starts small. Even a modest stake in a good business is better than a fat paycheck in a bad one. Here's a story. I knew a man who was the president of a large company. An impressive title, a huge salary, but he had no equity stake. When the company stumbled, he was thrown out. Meanwhile, a guy who quietly owned shares in a local bottling plant, hardly a glamorous occupation, ended up richer and freer. This is the trap of careerism, the illusion of security. Titles, corner offices, perks. They vanish the moment the wind changes. Ownership remains. In 2026, people will still be chasing shiny careers. They will brag about their job titles, LinkedIn endorsements, and offices. Meanwhile, the quiet investor who bought a great index fund or a boring industrial business will quietly outgrow them all. The difference is in the mindset. Careerists think in promotions. Owners think in compound interest. If I were starting with a clean slate, I would tell myself, never confuse a paycheck with wealth. A paycheck is fleeting. Ownership is lasting. And if you want to be truly secure, don't just climb ladders. Own them. If I were starting in 2026, I would carry with me one set of memories that has never left me. The Great Depression. I was born in 1924. By the time I was old enough to notice the world, it was broken. Men who once wore suits were selling apples on street corners. Families who had owned homes for generations suddenly became renters, or worse, homeless. People love to romanticize hardship. They say it builds character. That's partly true, but mostly it teaches you how quickly comfort can evaporate when stupidity accumulates. My grandfather ran a grocery store in Omaha. During the Depression, he had customers who couldn't pay. Some he supported on credit out of kindness. Some never paid him back. I saw good people struggling, not because they were lazy, but because the system collapsed around them. This experience burned a lesson into me. Never assume prosperity is permanent. The Roaring '20s went to everyone's heads. Stock tips flowed like whiskey. People borrowed to buy stocks, houses, anything that looked like a shortcut to wealth. Then 1929 hit. The same people who were bragging at dinner parties were suddenly standing in bread lines. That's why, when I hear people today saying, "This time it's different," I laugh. It is never different. Human nature guarantees another boom and bust cycle. If I were investing from scratch in 2026, I would plan for disaster as if it were inevitable. Because it is inevitable. You don't know when, but you know it will come. This means holding cash reserves. It means avoiding debts you won't be able to pay in bad times. It means never putting everything you have on the line. During the Depression, it wasn't necessarily the geniuses who survived. Those who survived were the ones who stayed liquid, avoided leverage, and kept their expenses below their income. It wasn't glamorous, but it worked. Even today, I cannot stand unnecessary debt. I saw families lose farms they had worked for generations because they couldn't cover the mortgage when prices fell. Banks don't care how hard you work. They care whether you can pay. If you can't, you're out. This memory shaped my entire philosophy. Debt is dangerous, envy is poison, and survival is more important than genius. Do you want to know why Warren and I never risked everything? Because we saw what happens when people do. I don't care how smart your model is if it relies on everything going perfectly. That's garbage. In 1973 and 1974, the market fell by almost 50%. People panicked. They thought, this is the end of capitalism. But Warren and I had cash. We could buy when others were in despair. That opportunity came only because we hadn't overextended ourselves beforehand. This habit is rooted in the Depression. You don't forget seeing grown men humiliated by hunger. You don't forget seeing the collapse of pride when the mortgage bill arrives. So, in 2026, here is how I would think. Expect recessions. Expect crashes. Expect the unexpected. Build your finances as if disaster is always around the corner. Then, when it comes, you won't be a victim. You will be ready. Another lesson. Dignity matters. During the Depression, I noticed that those who coped best were the ones who maintained their self-respect by living simply. They didn't try to keep up with the Joneses. They accepted reality, adapted, and endured. This is not just a financial principle, it's a life principle. If you live below your means, carry no unnecessary debt, and avoid envy, you will manage in any era, even in a repeat of the 1930s. And if you think the Great Depression can't happen again, congratulations. You've just qualified yourself as the very optimist history loves to humiliate. If I were starting in 2026, I would remind myself that 3 things destroy more lives than bear markets ever could: debt, drama, and fools. Let's start with debt. I've said this before. Debt is like a scalpel. It can be useful in the skilled hands of a surgeon, but most people just stab themselves with it. During the Depression, I saw families ground to dust because they mortgaged their farms. They weren't reckless. They just assumed the good times would last forever. Then the bottom fell out. The banks foreclosed, and proud people who had worked the land their whole lives were left with nothing. This lesson never left me. I avoided debt like the plague. Even when I could have used leverage to get richer, faster, I didn't. Why? Because leverage gives you speed, but not control. And if the road ahead suddenly collapses, speed kills. If you want to get rich slowly and safely, stay away from debt. It's that simple. Now, drama. Most people spend half their lives tangled up in drama. Family feuds, lawsuits, ego battles at work. I cut out most of that early on. If someone brought nothing but noise, I cut the cord. Drama doesn't just drain your mood, it drains your judgment. An angry or resentful person cannot think clearly, and clear thinking is your only edge in the market. So, if you are young today, learn to drop drama like a bad stock. Walk away. Don't fight. The time you save will compound, just like money. And finally, fools. It sounds harsh, but it's the truth. Stupidity is contagious. Spend enough time with fools, and you will start acting like them. That's why I filtered my inner circle ruthlessly. I wanted to be around rational, disciplined, and honest people. If someone was unreliable, corrupt, or irrational, I kept my distance, or better yet, avoided them entirely. You don't need hundreds of friends. You need a handful of reliable, rational partners. Warren was like that. Honest, frugal, and consistent. That alliance made both of us richer than we ever dreamed. Compare that to people who surround themselves with liars, cheats, or reckless gamblers. It always ends the same way, in misery. In 2026, this lesson is more important than ever. With social media, stupid people have been given megaphones. They will shout about the next big stock or guaranteed crypto riches. If you listen, you will go broke. Here is my filter. Avoid people who brag about fast money. Avoid people who cannot admit their mistakes. Avoid people who live on envy and debt. If you cut these types out of your life, you have already improved your odds of survival. It isn't complicated. Stay out of debt. Cut out the drama. Avoid fools. None of these rules will make you the life of the party, but they will preserve your solvency, your sanity, and your freedom. And in investing, freedom is priceless. Because here is the punchline. Debt ties you down, drama distracts you, and fools drag you to the bottom. Eliminate all 3, and compound interest will take care of the rest. If I were starting over in 2026, I would hope to find another Buffett. Not because you need one to survive, but because having the right partner multiplies everything. When I met Warren, he was already sharp. He thought in numbers the way musicians think in notes. But what made the partnership work wasn't just brains, it was temperament. We shared several traits. We hated debt. We hated envy. We loved to read and think. We were patient to the point of stubbornness. This alignment made us dangerous in a good way. The world sees our partnership as some kind of fairy tale, but the truth is, it was based on ruthless simplicity. We trusted each other to be rational. that is rarer than you think. What worked? First, the division of labor. Warren loved the insurance side and sniffing out deals. I pushed us toward focusing on buying great businesses rather than cigar butts. Together, we built a hybrid system. His nose for numbers, plus my nose for quality. Second, brutal honesty. We didn't coddle each other's bad ideas. If Warren proposed something stupid, I told him so. If I came up with nonsense, he nipped it in the bud. There were no hard feelings because the goal wasn't ego. The goal was the truth. Third, patience. We didn't have to swing at every pitch. Sometimes we sat for years without making major moves. That kind of discipline drove other people crazy, but it kept us alive when markets went mad. What didn't work? Well, we missed things. We were slow to grasp technology. We didn't invest early in companies like Microsoft or Google. We thought we had clearly defined circles of competence, and sometimes that made us too cautious. I admit that. We underestimated how quickly technology would rewrite the world. It cost us billions in lost opportunities. But here is the thing. You don't need to hit every ball to win the game. You just need to avoid striking out on obviously stupid pitches. Another flaw. We were stubborn. Sometimes too stubborn. We held on to businesses longer than we should have. We tolerated management that wasn't top-notch because we liked the history of the company. That loyalty cost us money. So, no, we weren't perfect, but we were consistent. And in investing, consistency beats genius. If I were starting today, I would look for partners who share values, not just skills. Competence is necessary, but character is non-negotiable. The wrong partner can sink you faster than any bear market. I've seen partnerships blow up because of greed, envy, or ego. Once trust is broken, compound interest stops. Warren and I never argued over money. It sounds trivial, but it's everything. If you can't trust your partner with $1, you can't trust them at all. People ask if I could have done it alone. Sure, I could have. But having Warren made it easier, safer, and frankly, more fun. We sharpened each other. And when one of us wavered, the other stood firm. That's what a good partner does. They don't cheerlead or flatter. They keep you grounded when the world goes crazy. So, if you are young in 2026, don't just look for investments. Look for allies. One rational partner is worth more than 100 smart acquaintances. And if you can't find a Buffett, make sure you at least avoid the opposite, a partner who drags you into envy, debt, or drama. That will kill you faster than any bad stock pick. Our partnership wasn't perfect, but it worked. And in investing, works beats perfect every time. If I were starting over in 2026, I wouldn't waste time chasing the next miracle. I would stick to the same boring formula that has worked for nearly a century. And here it is again, to cement it. Spend less than you earn. Avoid debt. Buy quality businesses or index funds. Sit still and let compound interest work. That's it. No secret sauce, no clever tricks, just discipline. People don't like to hear this. They want fireworks. They want me to whisper some ticker symbol that will turn into the next Amazon. They want shortcuts. But investing doesn't reward impatience. It rewards endurance. You don't need to predict the future to get rich. You just need to outlive your own stupidity. I've been watching this movie for almost 100 years. In 1929, The crowd was wiped out because they borrowed to chase stocks. In 1973, they panicked when the market dropped by half. In the 2000s, they bought dot-com garbage at insane prices. In 2008, they treated houses like lottery tickets. And in 2021, they thought meme stocks and crypto were a revolution, not a casino. Every generation makes the same mistakes. And every generation thinks, this time it's different. It never is. If you understand this, you don't need to be a genius. You just need to avoid being stupid. So, in 2026, what would I realistically do with my money? I would put a large chunk into low-cost index funds. Let the market work for me while I sleep. Then, I would keep my eyes open for the rare, obvious deal. Maybe once a year, if I'm lucky. And when I saw it, I would bet big. Not every month, not every week. Only when the odds are clear and the price is right. Meanwhile, I would hold cash reserves. Not because cash makes you rich, but because it gives you options when the world melts down. Most important of all, I would embrace boredom. People hate boredom. They think if they aren't trading, they aren't progressing. In reality, money is made in the waiting. Compound interest is like watching paint dry. But if you are patient enough, one day you will wake up and the wall will be worth a fortune. Warren and I didn't become billionaires by chasing thrills. We became billionaires by sitting still, while time and discipline did the heavy lifting. If I were starting today, I would remind myself daily, it isn't supposed to be easy. Anyone who finds it easy is a fool. The formula is simple. The execution is hard because it requires patience, humility, and the ability to ignore noisy people. But it works. It has always worked. And as long as human nature doesn't change, it will keep working. Boring gets rich. Exciting goes broke. If I were starting over in 2026, I wouldn't dream of yachts or mansions in Silicon Valley. I would think about survival, because survival is underrated. People imagine that wealth is built through brilliant flashes of genius. Wrong. It is built by avoiding stupidity long enough for compound interest to do its thing. It is not a glamorous truth. Getting rich is mostly about staying alive. The world will tempt you with noise, a new app, a new coin, a new guru screaming that this time it's different. Ignore them. If you can't ignore them, you will end up as their customer, not their competitor. Warren and I never had a grand plan to become billionaires. We just tried to avoid doing stupid things. We lived below our means. We bought good businesses. We let time do the work, and we repeated this decade after decade. Somewhere along the way, compound interest did the heavy lifting. By the time the crowd noticed, it was too late to catch up with us. That's how it works. Quiet endurance beats screaming genius. If you were starting out in 2026, ask yourself, do you want to look rich or be rich? It is not the same thing. Looking rich means debt, envy, and drama. Being rich means freedom, security, and peace of mind. I will leave you with this. If you don't spend less than you earn, I cannot help you. No one can, and if you think investing should be fun, you are playing the wrong game. Wealth does not go to the smartest, it goes to the most disciplined. So in 2026, do what I do. Live simply, think clearly, avoid stupidity. Let compound interest work. It won't feel exciting, but one day you will look back and realize that boredom made you rich, while fun bankrupted everyone else.